Have you ever looked back at a company like Nvidia and thought, man, how did I not see that one coming? Because right now, there's another name in the digital power and Bitcoin space quietly positioning itself for something much bigger than most investors realize. It's called CleanSpark. While the market still treats it like just another Bitcoin miner, what's really happening behind the scenes could make it one of the biggest digital infrastructure stories of the next few years. This isn't just a crypto play anymore. This is a company turning cheap, clean energy and compute power into a growth engine for the new digital economy. CleanSpark started like many others in the mining space, focused on Bitcoin. But the difference is how they approached it. Instead of chasing hash rate at any cost, CleanSpark built its foundation on one simple principle: efficiency through energy ownership. Most miners rent power or depend on third-party hosting. CleanSpark, they own and operate their sites, strategically placed in low-cost, renewable-heavy regions across the US, particularly in Georgia and Mississippi. That gives them some of the lowest energy costs in the entire Bitcoin mining sector, averaging around 2.5 to 3 cents per kilowatt hour, and in some cases even less. That's not just cheap, that's strategic advantage. Because as we enter an era where compute power is becoming the new oil, the companies that control their energy supply will dominate. Now, let's talk about timing. The next Bitcoin halving is right around the corner, which will cut block rewards in half. That event usually wipes out inefficient miners and rewards the ones who can survive on thin margins. CleanSpark has already been preparing for it. They've grown from under 3 EH per second in 2022 to over 20 EH per second targeted for 2025, with plans to exceed 50 EH per second longer term as new sites and acquisitions come online. But here's what's even more impressive: they've done it without drowning in debt. While competitors like Marathon and Riot leaned heavily on dilution or leverage, CleanSpark stayed lean, maintaining a healthy balance sheet and consistent profitability, even through bear markets. In other words, they're building through the cycle, not just surviving it. Over the past year, CleanSpark has been snapping up distressed assets from smaller miners who couldn't handle the cost pressure. They've acquired multiple fully operational sites, expanded energy contracts, and integrated new capacity faster than almost anyone in the space. Their Washington and Sandersville sites alone added hundreds of megawatts of infrastructure, all powered by a mix of low-carbon and renewable energy. And that's where the narrative starts to shift. Because CleanSpark isn't just scaling hash rate, it's scaling infrastructure. Each one of those data centers can be adapted for AI compute, HPC workloads, or blockchain hosting in the future. They're building the same type of high-density, energy-efficient facilities that NVIDIA-based AI clusters run on. That means they're not locked into one market forever. They're building assets that can pivot when the time comes. Think about this. In a world racing toward AI, cloud computing, and decentralized finance, power is the ultimate bottleneck. Tech giants like Amazon, Microsoft, and Google are scrambling to find enough power for data centers. Meanwhile, CleanSpark is sitting on hundreds of megawatts of ready-to-scale infrastructure, already interconnected, permitted, and powered by stable grid agreements. That's the same setup that turned companies like Core Scientific and Iris Energy into hybrid mining plus AI compute plays. But CleanSpark is arguably better positioned because of its focus on owned energy assets and US-based operations. When everyone else is fighting for grid capacity, CleanSpark already has it. That's how you win in the next wave of compute demand. In their most recent reports, CleanSpark generated record revenues, improved gross margins, and maintained positive operating cash flow, even with Bitcoin below all-time highs. Their cost per Bitcoin mined is among the lowest in the sector, and their balance sheet strength, over $200 million in cash and crypto holdings, gives them flexibility for expansion without excessive dilution. they've also continued to build Bitcoin reserves instead of liquidating everything, giving them long-term exposure to price upside while still funding growth organically. On a valuation basis, CLSK trades at a fraction of peers like Riot or Marathon, despite comparable or better energy efficiency, faster scaling, and lower debt. That's why more and more analysts are calling CleanSpark one of the most undervalued crypto infrastructure plays on the market. But here's where things get even more interesting. The global demand for compute is exploding. AI models like GPT, data analytics, and decentralized applications all rely on high-density, energy-efficient data centers, exactly what CleanSpark already operates. Several miners have begun exploring GPU integration or colocation for AI workloads. CleanSpark's facilities are ideal for this kind of diversification, especially in states with favorable energy pricing and permitting. While CleanSpark hasn't officially shifted into AI hosting yet, the groundwork is there. They've already discussed infrastructure-level flexibility, meaning their next phase could easily include hybrid AI and blockchain compute, just like we're seeing from companies like Core Scientific or Iris Energy. If that transition happens, even partially, it could unlock massive new revenue streams beyond Bitcoin mining alone. So what could drive CLSK higher in the next 2 years? The Bitcoin halving impact. As weaker miners drop off, CleanSpark's efficiency becomes even more valuable. New capacity online, dozens of megawatts in development that could double operational power by 2026. Potential AI hosting shift, strategic expansion into GPU compute or colocation, macro tailwinds, energy independence, AI growth, and the next digital infrastructure boom, and institutional adoption. As crypto and clean energy narratives merge, institutions are looking for US-based, ESG-friendly miners, and CleanSpark fits that bill perfectly. Let's be real, no stock is a straight lineup. CleanSpark still faces volatility from Bitcoin price swings since most of its revenue is tied to mining. Energy regulation risk is also real. Future policy shifts could impact grid access or pricing. And as the company scales, capital intensity becomes a factor. New sites, hardware, and expansion all require cash. Lastly, competition remains fierce. Players like Marathon, Riot, and Core Scientific are also expanding aggressively. But what sets CleanSpark apart is execution. Their track record of scaling efficiently, avoiding heavy dilution, and maintaining profitability even in downturns. At its core, CleanSpark isn't just a Bitcoin miner. It's becoming a digital energy company, one that controls the two most valuable resources of the modern age: power and compute. They've proven they can scale fast, run lean, and adapt as the market evolves. And as the worlds of AI and blockchain continue to merge, companies like CleanSpark, with real infrastructure, real power, and real scalability, could become foundational players in the next digital revolution. At today's valuation, CLSK might be one of the few small caps positioned to benefit from both the Bitcoin halving cycle and the global compute explosion that's only just beginning. If you believe the future runs on power and computation, CleanSpark might just be one of the smartest, most overlooked bets in the entire market right now. They've got the assets, the execution, and the timing, and they're building in silence while everyone else is still catching up.